Inflation and central bank policy expectations continued to be key drivers of investment market performance throughout the second quarter of calendar year 2024. Early in the quarter, hotter than expected inflation data and higher bond yields weighed on asset prices, leading investors, particularly in the US and Australia, to adjust their expectations for when each country's respective central bank would alter their monetary policy settings. This shift resulted in the first bout of 2024 volatility. From there, continued economic growth, though at a slower pace, combined with ongoing enthusiasm around the artificial intelligence thematic, and helped buoy investor sentiment and push asset prices higher later in the quarter. This clear trend during this quarter, similar to prior periods, was that a very narrow group of companies performed exceptionally well, keeping most major indices in the green for fiscal year 24. However, this has masked the fact that many index constituents materially lagged the market. During the quarter, we saw the US equity market rally strongly, dragging up benchmark global indices such as the MSCI All-Country Weighted Index, whilst global small companies and value equities, Japan and Australia all lagged. Europe had modest positive returns, as did the UK's FTSE 100. Emerging markets and Asia both performed well, though the Shanghai Composite fell on economic concerns and the South Korean Kospi Index underperformed its Asian counterparts. As per our comments last quarter, much of this rally in equities was driven by expansion in multiples being paid, so higher prices, not driven so much by any expansion in earnings. Yes, earnings revisions were positive, but as per the following chart, the magnitude of the price rises far exceeded the earnings upgrades, indicating that the market was optimistic these earnings upgrades could continue on for some time. We went on record several times over the past year to say that we believed this unrestrained optimism presented a risk to markets, as any misses on earnings or unexpected downturn in US GDP could be catastrophic for such richly valued businesses. And perhaps some reality now appears to be dawning in the early parts of this third quarter, with the current softening in these names. Having said that, within the US and also globally, we were also cognizant that there were plenty of equity market opportunities that didn't carry the same lofty price tags. Indeed, these can be seen in the various areas we hold exposure to within the Innova portfolios, including such things as quality small caps, Asia, emerging markets, and the UK, to name a few. Over the quarter, we also began to feel some concerns regarding Australian equities, as they reached all-time highs at a time when earnings were in fact being downgraded, making Australian equities relatively less attractive. Australia has been in what we call a GDP per capita recession, meaning that if we stripped out the effects of immigration, economic growth was actually negative. And Australian consumers are feeling the pinch of higher mortgage rates, whilst inflation remains sticky and won't recede quickly. Therefore, we feel it prudent to be more exposed to Australian defensive sectors and use a risk-weighted exposure to cyclicals as a hedge in case we are wrong. My colleague Shane Wang will elaborate on this in his discussion of the outlook from here.